Alright, if you haven't already downloaded the Chapter 12 handout, make sure you do that before you start. We'll start out with problem 1. Now, we're going to start out with the time value of money, basics. So what I want you to do is go to the back of the handout. In the back of the handout, you're going to find a couple of different tables, and the one I want you to take out is on page 11, the single payment table. I'm going to use this table here. My table has a few less numbers on it, but the same idea as yours. And we're going to take a look at it. One thing you're going to notice about the table is it has percentage rates on it. If you think about inflation, when we look at these numbers, so these percentages will be sort of like inflation. And the idea being is that in the future, a dollar received isn't going to buy as much as it does today. So for instance, at 1%, the value of a dollar will buy about what 99 cents would buy today. So 1 year from now, if the inflation rate was 1%, 99 cents today would buy about the same as a dollar would a year from now. And as you go across, you see at 5%, if the interest rate was at 5%, if inflation was at 5%, then about a dollar received a year from now would be worth about 95 cents today. In other words, you can buy for 95 cents what you're going to pay a dollar for a year from now at 5%. You'll notice as the interest rate goes up, or the inflation goes up, it becomes worth less and less and less. So as the percentages go up, the value of the dollar received goes down. And same thing if you go into the future. The further you go into the future, the less and less and less the dollar is. So 20 years from now, a dollar is going to be worth about 31 cents. In other words, you buy for 31 cents today what you'll be able to buy for a dollar in 20 years at 6%. So we're going to see how we use these tables. All right, let's take a look at problem number 1. Grandma promised to pay your grandchild $1,000 in 3 years, and the discount rate is 6%. So I'm just going to graph this out, just kind of give you a visual here of what's going on. So 3 years from now, Grandma's going to give us $1,000, or give her grandchild, I should say, $1,000. We're not going to get $1,000, but we want to figure out what that gift is worth today. All right. Well, we're going to look at our table here. And make sure you're on the single payment table. It should say single payment table. It's page 11. You got page 12, change it to page 11. Okay, so for 3 periods, and at 6%, that's going to be the value of all those dollars. So each dollar is going to be worth about 84 cents. So 3 periods, 6%, 84 cents. So each dollar that Grandma's going to give us is really only worth about 84 cents today. In other words, that those dollars are only going to buy what we can buy today for 84 cents. Well, if Grandma gives us 1,000 of them, so 1,000 times Grandma's gift is going to be worth $840. So again, we're just multiplying $1,000 times what each dollar is going to be worth. So Grandma's gift today is worth $840. In other words, you can buy today for $840, but you're going to pay $1,000 for in 3 years. All right, let's go to problem 2. See if you can figure that one out. You might want to pause this if you want to give it a shot on your own. Okay. Well, Grandma promises to pay $1,000 again. But this time it's for 5 years. And the interest rate is 10%. Alright. So we want to see what that's worth today. Pull out our table. Make sure you're on the single payment table again. We're going to be using the single payment table for a while here, so page 11. Go to 5 periods. And we go across to 10%. So each one of those dollars is going to be worth $0.621 today. In other words, 62 cents, what you can buy for 62 cents today, in 5 years at 10%, you'll be paying $1 for. Alright, well, let's take a look here. So this is $1,000 we're getting in 5 years. Get back to today. Take 1,000 times 0.621. So each dollar is going to be worth 0.621. So if you use 1,000 of them, that's going to be 1,000 times 0.621. So $621 is what you should have got for that one. So Grandma's gift is worth $621. So at 10%. What you pay $621 for today, you're going to pay $1,000 for in 5 years at 10%. Now notice something. Grandma gave us $1,000 in both situation 1 and 2, problem 1 and 2. You'll notice that problem 2 is worth much less. You say, well, why? Well, because it's 5 years and it's 10%. So it's waiting longer for the money and it's at a higher discount rate. Alright, let's go on to problem 3. And problem 3 is a little bit different than the first couple ones here in that we're going to make a decision. Alright, problem 3. Aunt Susie gives her niece a choice of $1,000 in 3 years. So, there's choice 1. Or $1,200 in 5 years. The discount rate is 8%. So we're going to try to figure out which one we, her niece, Susie's niece, should pick. Should she take the $1,000 in 3 years or the $1,200 in 5 years? And what we're going to do is bring those back to today and see what they're worth at 8%. All right, well, let's take the first one here, 3 years at 8%. So the factor we're going to use is right here, 0.794. So that's what each one of those dollars is going to be worth in 3 years. So we're just going to multiply it. And again, that's just what the factor we got from the table. So $1,000 3 years from now at 8% is going to be worth $794 in today's dollars. So $794 will buy the same as $1,000 in 3 years. All right, let's go to the next one. We have $1,200 in 5 years. Okay, well, so for periods, we're going to have to wait till 5 years. It's still going to be at 8%. So we're going to take 0.681. So those dollars are really only worth around 68 cents 5 years from now. So we're going to bring these back to today. 1,200 times our factor. And again, that just came from the table. So $817 and 20 cents, or 0.2. So that is what the 1,200 is worth. So, which would you rather have, $817 or $794? Well, you'd probably want the one that was higher, right? It's better to have $817 than it is to have $794. So that's the one we're going to want to pick. Or I should say the niece is going to pick. Or that we're going to pick for the niece. All right, let's go on to problem 4. Problem 4 is a similar one. The only thing that's different on problem 4 the gifts are exactly the same. Only in this one, the discount rate is 12%. So $1,000 in 3 years. Take it back to today. Let's see. Make sure you're on the single payment table again. 3, 12%. equals 7. $0.712. So each dollar is going to be worth around 71 cents today. All right, well, let's see what Grandma's gift's worth. She has 1,000 of these dollars she's going to give us, so 1,000 times. So $1,000 is going to be worth $712 today. Okay, well, let's see. For the $1,200, it's still for 12% for 5 periods. So we're looking at 0.567. Okay. So 1,200. And each one of those dollars is worth 0.567, a little more than 56 cents, 57 cents, somewhere in there. So we're going to multiply that out. So $680.40. Again, that just comes from the table. All right, well, which would you rather have, $712 or $680? That's your choice. So for the niece, which one will you tell them? We tell them to go with the 712. Now you notice something. If you go back to number 3, the only thing that was different was the interest rates for those two. But it changed which one we would pick. So the moral of this story is that the interest rate can actually change your decision. Okay, let's go on to problem 5. And problem 5, we have Uncle Fred, and Fred promised to pay his nephew $1,000 at the end of each year for the next 3 years. All right. Discount rate is 8%. Well, we should probably do these in order. Let's take this first one. Bring this back to today. Now notice this is only one period out. The first payment's going to be within one period from now, a year from now. So we go to our table. 1 period. 8%. So that's going to be the first one. 1 period at 8%. 0.926. We're going to get 1,000 of these. No, we're not going to get it. The nephew is. So the first one's going to be worth $926. Do the same thing with the second one. Now remember, this is going out for two periods. So now we're going to come down here, and those dollars are going to be worth 0.857. So about 85, 86 cents, somewhere in there. So 1,000 times 0.857 equals $857. Alright, last but not least, actually it is the least, we're going to find out. Last and least is the $1,000 3 years from now. And it's least because it's further out in the future. Only worth about 79 cents each. So that is the value of Uncle Fred's gifts to his nephew. Add them all up. And you'll see that they're worth $2,577. Now you notice something a little bit repetitive about our calculations here. Take 1,000 times 0.926, 1,000 times 857, 1,000 times. So it might be easier just to add up all those factors and instead of multiplying it three times, just multiply it once. Well, thankfully, we have a table that does this for us. Now, it's only going to be used for annuities. So pull out the annuity table, and again, that's going to be page number 12. It'll say annuity at the top. I'll show you mine. Alright, so this is page 12 of your handout, and again, this is an annuity table, and an annuity is sort of a special type of inflows in that they are all equal. And you'll notice that our factor of 8% for a 3-year annuity was the 2.577. So that's how they got this annuity table. That's how they made this table, is adding up those single payment tables and saying, okay, if it's an annuity, we can just multiply it once. So all the payments are equal, that's when you can use the annuity table. If the payments are not equal, you cannot use this table. You have to use a single payment table. So you only use this table when the payments are the same. So here's how we do this. We are going to bring those back. Now, again, these are all equal payments, so we can use the annuity table because they're equal. And you might be a little skeptical and say, well, how often are the payments equal? Well, there are a lot of things in business that have equal payments. Mortgages, loans, and all that. So we're going to multiply this only once, though, to get the present value. And again, the beauty of this is that it saves a whole lot of time. Maybe not in this case, with 3 periods isn't that big a deal. But if this was 30 periods, it would be no fun at all to use a single payment table. So you can always use a single payment table, but if it's an annuity, you might be better off using the annuity table because it'll save a lot of calculations. Let's go to problem 6. And problem 6 is one that you're definitely going to want to use the annuity table for. Fred wants to pay his nephew $1,000 at the end of each year for the next 7 years. All right. And the discount rate is 6%. So $1,000. I'm going to skip a couple years in here. Don't have enough room on the paper. So 3, 4, 5, 6 will be scrunched up in there. Now, we could do 7 calculations on the single payment table. 7 years, 7 payments, and we would come out with the correct answer. But since this is an annuity, let's save some time. And do it all at once. So we're going to take 6%, 7 periods. So 5.582. So this is what Fred's gift is worth. $5,582. And again, we could do 7 calculations on the single payment table, and we should come up with that same number. Might be off a little bit because of rounding, but it'd be pretty close. So that is what Uncle Fred's gift is worth. Okay, problem 7. Winning the lottery. Probably won't happen too often, but if it does, you're going to want to know this. Alright, Janet wins $2 million in the lottery. The money's going to be paid out at a rate of $100,000 per year for the next 20 years. Right. And the discount rate is 8%. We could use a single payment table, but that would take a really long time because we'd have to do 20 calculations and then add them all up. So let's use the annuity table. It's much quicker. And luckily this is an annuity. They're going to pay the same amount for the next 20 years. Alright, well, let's take a look here. 20 years. %. 9.818. So that's what we're going to multiply times our 100,000. Alright, so Janet really didn't win $2 million. Janet won $981. Scratch that. $981,000 and $981,800. So she didn't win $2 million, but she's probably still pretty happy. Okay, let's go on to page 8. Page 8 is a much more common occurrence, and that is you get an offer to go into business to buy a bicycle shop or a restaurant or whatever it is you want to go into business for yourself. And the question is, well, how much should you pay for this place? So, say we're getting a bike shop, and the owner says, "Hey, I'll sell you the bike shop for $600,000." The shop will earn $100,000 for the next 15 years, and the discount rate is 8%. Discount rate in this case, a good one to use would be the bank rate, what the bank would charge you for a loan. Just use that as the discount rate. So 8% for 15 years. Our factor is 8.559. So 8%, 15 years, annuity table. Again, we could use the single payment table, but it would take a really long time. So to speed things up, we'll use the annuity table. We'll go all the way up to 15 years. I didn't put in years 3 through 14. But this is an annuity. They're all equal payments. Times 8.559. So, the bicycle shop is actually worth $855,900. So that's going to be the value of the bicycle shop. So that's the value of the business. So you say, yes, I'll buy for $600,000 your shop that is worth $855,900. The value of the business, and again, this is today, right now. This is what the business is worth. These are in today's dollars, so we can compare them.